Hello and welcome to the January 2026 edition of the Economic Update from Kingdom Focus Financial. We have today Michael Smith, Chuck Etzweiler, myself, Derek Mauldin. We've got some information just general about what we're looking at in the market heading into 2026 here. So let's take it away, boys.
Hey, thanks, Derek, and Happy New Year, everybody. We are off and running here early in the year already, and what a year it is going to be coming up. Already some important economic factors and developments in the news, and I'm sure that's always the case because as we talk to each of you, there's always something going on that is of concern or that makes you feel good or not good. And so we want to highlight that today and just spend this month's time kind of giving you our outlook for this year. We introduced last month our theme for this year. We'll re-talk about that today, but if you haven't watched last month's, go back and watch it when you're done watching this one and hear about our wiser theme for 2026. But today, let's kick the year off with just kind of a what can we expect? And Chuck, I'm gonna turn this to you here to give us some economic data that we can use as a guideline. And obviously, we can't predict the future. I say that almost every time because there are attorneys and so forth want us to say
Right.
that. And we've been doing this a long time, and we know we can't predict, but we can use data and history to guide and make informed and calculated decisions in our portfolio selection and management. And so tell us a little bit about what this year, from an economic cycle and a presidential cycle, might might have in store for us too.
Certainly, Michael, and Happy New Year to you and Derek, and to all our investors and listeners. Thanks for joining. We enter into a year when we have a midterm election, which certainly coincides with the second year of a president's term. We all know that. Historically, there's been, we'll use the word tumult in the market in the second year. And as this first slide shows, what tends to happen, and we went all the way back, gents, to 1928, years 1 and 4 of a president's term historically tend to be average, which is, say, between 7 and 9%. Year 2, and even in an era where we have polling, where we have significant data ahead of an election year, think about what we have. We got 435 House of Representatives seats up for bid, numerous senatorial and gubernatorial races that really give a question mark to what the political winds are going to be come November. We tend to see this flatlining. We see a little bit of a upswing in Q1, but Q2 and Q3 tend to sell off. The good news is historically that year 2, by the fall of the year, tends to rebound and take itself all the way into year 3. And I think that's the good news here, guys. There's a silver lining that just based on this metric alone, we probably will see a little more volatility throughout the second year of a president's term. And you can see here on the second slide, kind of break down the first one into numerical percentages. I think the one that I would highlight the most is that the second year of a president's term, albeit weak, still has a 54% percentage of being positive. So again, we're probably taking this year and saying to our investors, we like the way we're positioned, which we'll speak about in subsequent podcasts. But for now, to just tell people, we probably would be a little bit cautious going into the second year. Now, on top of that, Michael and Derek, as the third slide says, it's not only a midterm election year, it's also the fourth year following 3 years previously where the rate of return was 10% or more. And when you think about that, that's only happened 5 times since 1928. So again, just to recap this slide on 3, a little bit busy. 5 other times going back to 1928, we've had 3 years greater than 10%. So think of 2023, 24, and 25. 24%, 23%, and last year 16%. What could be in the picture for the fourth year? Well, history would suggest, as you can see, that orange line, Michael and Derek, almost follows a pattern like what we just saw in the second year of a president's term, the midterm year. You see the same slope of the line. Market starts out fairly decently, rises up until May or June. The old selling may go away. And you can see my green arrow where we flatline or slightly down while we're entering into the fourth quarter. But then again, we see that yellow line, that arrow should say, moving north, the orange line. If we capture this just in one slide, you can see now the red line shows what we did in the previous slide, which was orange. And you lay this out, I think the old picture paints 1,000 words, and I added that green arrow in there. So again, a rare event due to the fact that we hardly ever get 3 consecutive years of 10+% gains. So what would history say? On average, maybe middle to high single digits. I think for most people, if in fact we get a little choppiness to the downside throughout this year, most people would find that palatable. But again, just laying it out, Michael, is a little bit of caution here. Probably is the best way that we can describe how we think this year is going to unfold from that perspective.
Yeah, and I'll take that, Chuck. And I know we talk, all the time, and we've been kicking this around for a while. And I think the best way I want to put this to all of you who are watching is there's a lot of positive things happening currently, and historically, mm, growth is the winner when we look at odds overall. But this is one of those years for all my NASCAR fans out there. This is where the yellow caution flag gets thrown, right? There's debris on the track, there's something in the way. We have to slow down and just drive a little more intentionally and drive a little more carefully, um, because there are some unknowns. And while history doesn't always repeat itself in the same timeline, there's some real historical significances here. And one of those, as you mentioned, that midterm election, but in layman's terms, you've heard me talk about how the market cares more about the Senate and the House of Representatives, the ones who can make and pass laws and legislation, versus the White House. And that really plays out when we see that market angst that develops as we go through. But there's one other thing I want to point out that I think everyone should be aware before you pick up the phone and call our office and say, get me out of the market if you're unsure about this year. We do have a positive outlook overall because there is a lot of growth and economic factors coming into play. And also, dips tend to be non-predictable in timing, but also short-lived. And so if you really dive in and look at the details of the data and the charts that we presented, we have a very positive outlook for the first quarter and into the second quarter this year, and then anticipate the summer as people get worried about what's going to change and what's going to happen. That tends to put a drag on the market in the third quarter, or maybe even into fourth quarter of this year. But then once that is passed come election, things settle in. And now we're into typically some of the best years of a presidential cycle coming up. We'll save that for future talks, but hopefully that helps put some realistic numbers behind some of those.
Yeah,
as
certainly.
well.
And we've said that here before. 1 out of every 4 years is usually not the greatest, right?
Yeah.
2 out of 10, something in that range. And this is potentially one of those years. And if you want to think about it, instead of like a up and to the right always, this year, if we looked at it from beginning to end, we may be more of a bowl shape, right? We may start here and have a lull in the middle and then kick back up at the end.
Yeah.
Yeah, well said, gents. Maybe we could wrap this up here. So we talked about 2 things, right? The midterm election, and you just nailed that, Michael, and Derek, you did the same thing with the year 4. We look at this last slide. I'm going to put my contrarian hat on, and why is that? We don't give ourselves pats on the back, but let's go back a couple of years here. Remember, 2022 was our wait year. We were suggesting be patient. There could be something forthcoming with this thing called artificial intelligence. And it did happen in the fourth quarter. That large language model developed by OpenAI called ChatGPT was launched and changed history. 23 and 24, many people are pessimistic, calling for certainly the Fed to continue to raise rates. Recession, we were never in that camp. But here we sit in this last slide. There is not one Wall Street firm calling for a negative year, and mostly all are very bullish. Now, why does that make me somewhat skeptical? Is that if the whole complex is suggesting the same thing like they had did in the past 2 years, that maybe there's just a little bit of a pause here, Michael. And I love the NASCAR, if you would, cautionary yellow flag that came out. I think that's a great metaphor that leads us into the close here. So I'm going to pass it back to you. I think all in all, this will be a decent year, but again, a little throwing caution at the wind here.
Yeah, and you're right. We have to think both sides of the fence, right? And so that everyone who has put your trust in us and you understand, we're not just like, woo, yay, happy. No, we put a lot of thought into both sides, and the herd mentality and what happens is real. And so when everyone's finally saying it's going to be good, yeah, that's when you start going, let me know where the exit is, right? And doing that. And so we have applied that lens in what we're looking at. What I think it will mean for you clients in our portfolios is while we have had a really solid mix and we've made very little changes during the course of a year, the past couple of years, you may see us do a little more tweaking this year. You will see us adapt and adjust. Interest rates sliding down slightly impact some of the positions we hold, and sectors of the market are certainly going to shift and change more frequently this year as we navigate that market, because things don't drop like this. They kind of all work their way down, and we'll navigate through that. You'll see that in our portfolios throughout the year. But overall, I think 2026 could be a pretty good year for folks. Any final thoughts, Derek?
Well, I would just say that you've heard this here, and if you have any questions, give us a call, and we'll be happy to talk through those with you specifically about your portfolio. And if you haven't already, like and subscribe so that you can get these every month.
All right, perfect. Hey, thanks for watching us this year. Know that by the time you're watching this video, you should be starting to be thinking about your tax documents. Two quick reminders. Employment-related tax documents come here at the end of January, but investment-related documents typically don't come out till mid to the end of February. So don't panic. Know that it takes some time. That's the normal cycle and schedule. Thank you for being here. Thank you for watching us. I wish you the best and happiest of years in 2026 and look forward to seeing each of you. Take care.